Now speaking, Jessica Hansen, Vice President, Investor Relations. Good morning and thank you for joining us today. We are pleased to report our financial results for the third quarter of fiscal 2023. Our net income was $1.2 billion, up from $1.1 billion in the same period last year. Our total revenues increased by 8% to $7.3 billion, driven by a 9% increase in home building revenues. Our gross margin was 22.4%, up from 21.9% in the same period last year. We also saw an increase in our backlog of homes, up 11% from the same period last year. We are pleased with our performance this quarter and remain confident in our ability to continue to deliver strong results. We look forward to continuing to execute on our strategic initiatives and delivering value to our shareholders. Now speaking, David Auld, President and Chief Executive Officer. Good morning everyone. I am pleased to report that D.R. Horton had a successful third quarter, with earnings of $3.90 per diluted share and pre-tax income of $1.8 billion on an 11% increase in revenues to $9.7 billion. Despite high mortgage rates and inflationary pressures, our net sales orders increased 37% from the prior year quarter, as the supply of both new home and existing homes at affordable price points is limited and demographics supporting housing demand remain favorable. We increased our home building starts to 22,900 homes this quarter, supported by a 6% sequential increase in our active selling communities. Our home building return on inventory for the trailing 12 months ended June 30th was 31.8%, and our return on equity for the same period was 24.3%. Our home building operating margins are lower than the record high margins we reported last year due to cost inflation and pricing adjustments and incentives we implemented to address homebuyer affordability challenges caused by higher mortgage rates. However, our margins improved sequentially from the March to June quarter as home prices and incentives have stabilized and some reductions in construction costs are now being realized in our homes closed. We are focused on consolidating market share by supplying more homes to meet homebuyer demand, while maximizing the returns and capital efficiency in each of our communities. We will maintain our disciplined approach to investing capital to enhance the long-term value of our company, including returning capital to our shareholders through both dividends and share repurchases on a consistent basis. Now speaking, Paul Romanofsky, Executive Vice President and Co-Chief Operating Officer. Our third quarter earnings decreased 16% to $3.90 per diluted share compared to the prior year quarter. Net income for the quarter decreased 19% to $1.3 billion on consolidated revenues of $9.7 billion. Home sales revenues were $8.7 billion on 22,985 homes closed, with an average closing price of $378,600, flat sequentially and down 3% from the prior year quarter. Now speaking, Mike Murray, Executive Vice President and Co-Chief Operating Officer. In the third quarter, net sales orders increased 37% to 22,879 homes and order value increased 26% to $8.7 billion. The cancellation rate was 18%, flat sequentially and down from 24% in the prior year quarter. Average number of active selling communities was up 6% sequentially and 8% year over year. Average price of net sales orders was $381,100, up 2% sequentially and down 8% from the prior year quarter. To adjust to changing market conditions and higher mortgage rates, incentives were increased and home sizes were reduced to provide better affordability. Home prices and incentives have begun to stabilize, but incentives will remain higher than last year. Sales volumes can be significantly affected by changes in mortgage rates and other economic factors, but we will continue to start homes and maintain sufficient inventory to meet sales demand and aggregate market share. Now speaking, Bill Wheat, Executive Vice President and Chief Financial Officer. In the third quarter, our gross profit margin on home sales revenues was 23.3%, up 170 basis points from the March quarter. This increase was due to a decrease in incentive costs and lower stick and brick costs on homes closed during the quarter. On a per square foot basis, home sales revenues and lot costs were both flat sequentially, while stick and brick costs per square foot decreased 4%. We expect to continue offering a higher level of incentives as compared to 2022, but due to recent stabilization in home prices and some reductions in both incentives and construction costs, we anticipate our home building gross margins to be slightly higher in the fourth quarter compared to the third quarter. Now speaking, Jessica Hansen, Vice President, Investor Relations. In the third quarter, our homebuilding SG&A expenses increased by 6% from last year and homebuilding SG&A expense as a percentage of revenues was 6.7%, up 10 basis points from the same quarter in the prior year. Fiscal year-to-date homebuilding SG&A was 7.2% of revenues, up 30 basis points from the same period last year. Now speaking, Paul Romanofsky, Executive Vice President and Co-Chief Operating Officer. In the June quarter, we started 22,900 homes, a 15% increase from the March quarter. We ended the quarter with 43,800 homes in inventory, down 22% from a year ago and flat sequentially. Of these, 25,000 were unsold, with 5,700 completed. Our construction cycle time decreased by over a month from the second quarter, reflecting improvements in the supply chain. We expect to see a further decrease in our cycle time for homes closed in the fourth quarter. We will continue to adjust our home ingestion, inventory and start pace based on market conditions. Now speaking, Mike Murray, Executive Vice President and Co-Chief Operating Officer. At the end of the second quarter, our lot position consisted of approximately 555,000 lots, with 25% owned and 75% controlled through purchase contracts. 34% of our owned lots are finished and 53% of our controlled lots will be finished when we purchase them. This capital-efficient and flexible lot portfolio is a key strength for our competitive position. In the third quarter, our investments in lots, land, and development totaled $2.2 billion, a 25% increase from the prior year quarter and 27% higher than the previous quarter. Specifically, we invested $1.2 billion in finished lots, $700 million in land development, and Now speaking, Paul Romanofsky, Executive Vice President and Co-Chief Operating Officer. During the quarter, our rental operations generated $162 million of pre-tax income on $667 million of revenues from the sale of 1,754 single-family rental homes and 230 multifamily rental units. Our rental property inventory at June 30th was $3.3 billion, consisting of $1.9 billion of single-family rental properties and $1.4 billion of multifamily rental properties. This quarter saw significant increases in both revenues and profits for our rental operations, as our platform expands across more markets. For the fourth quarter, we expect our rental revenues to be greater than our third quarter and our rental profit margin. Now speaking, Bill Wheat, Executive Vice President and Chief Financial Officer. Forestar, our majority-owned residential lot development company, reported total revenues of $369 million for the third quarter on 3,812 lots sold with pre-tax income of $62 million. Forestar's owned and controlled lot position at June 30th was 73,000 lots, 57% of which are under contract with or subject to a right of first offer to D.R. Horton. During the third quarter, Forestar purchased $270 million of finished lots from D.R. Horton. Forestar is separately capitalized from D.R. Horton and had more than $780 million of liquidity at quarter end, with a net debt-to-capital ratio of 19.1%. Forestar is well positioned to capitalize on the shortage of finished lots in the home building industry and to aggregate significant market share over. Now speaking, Mike Murray, Executive Vice President and Co-Chief Operating Officer. In the third quarter, our financial services earned $94 million of pre-tax income on $229 million of revenues, resulting in a pre-tax profit margin of 41.2%. 99% of our mortgage company's loan originations related to homes closed by our home building operations, and our mortgage company handled the financing for 74% of our buyers. FHA and VA loans accounted for 51% of the mortgage company's volume. Borrowers originating loans with DHI Mortgage this quarter had an average FICO score of 723 and an average loan-to-value ratio of 88%. First-time homebuyers represented. Now speaking, Bill Wheat, Executive Vice President and Chief Financial Officer. Our company has maintained a strong balance sheet with low leverage and significant liquidity, providing us with flexibility to adjust to changing market conditions. During the first 9 months of the year, our cash provided by home building operations was $2.1 billion, and our consolidated cash provided by operations was $2.3 billion. At June 30th, we had $4.6 billion of home building liquidity, consisting of $2.6 billion of unrestricted home building cash and $2 billion of available capacity on our home building revolving credit facility. Home building debt at June 30th totaled $2.7 billion, which includes $400 million of senior notes that we redeemed early in July. Our home building leverage was 11.1% at the end of June, and home building leverage net of cash was 0.7%. Our consolidated leverage at June 30th was 22%, and consolidated leverage net of cash was 11.2%. At June 30th, our stockholders' equity was $21.7 billion, and book value per share was $64.03, up 23% from a year ago. For the trailing 12 months ended June, our return on equity was 24.3%. During the quarter, we paid cash dividends of $85 million, and our board has declared a quarterly dividend at the same level as last quarter to be paid in August. We repurchased 3.1 million shares of common stock for $343 million during the quarter for a total of 7.7 million shares repurchased fiscal year to date for. Now speaking, Jessica Hansen, Vice President, Investor Relations. We expect to close between 82,800 and 83,300 homes in our home building operations and between 6,500 and 7,000 homes and units in our rental operations for the full year. Our consolidated revenues for fiscal 2023 are expected to be in a range of $34.7 billion to $35.1 billion, with greater than $3 billion of cash flow from operations in fiscal 2023. We anticipate share repurchases of approximately $1.1 billion in fiscal 2023, similar to last year. For the fourth quarter, we expect consolidated revenues of $9.7 billion to $10.1 billion, and homes closed by our home building operations to be in the range of 22,800 to 23,300 homes. Home sales gross margin is expected to be approximately 23.5% to 24%, and home building SG&A as a percentage of revenues in the fourth quarter to be in the range of 6.7% to 6.8%. Financial services pre-tax profit margin is anticipated to be around 30% to 35%, and our income tax rate to be approximately 24.5% in the fourth quarter. We will continue to balance our cash flow utilization priorities among our core home building operations, our rental operations, maintaining conservative home building leverage and strong liquidity, paying an increased dividend, and consistently repurchasing shares. Now speaking, David Auld, President and Chief Executive Officer. In closing, our results and position reflect our experienced teams, broad geographic footprint, diverse product offerings, and industry-leading market share. We have a disciplined approach to investing capital to enhance the long-term value of the company, which includes returning capital to our shareholders through dividends and share repurchases. Our operating platform is designed to sustain consistent returns, growth and cash flow, while continuing to aggregate market share. We thank the entire D.R. Horton team for their focus and hard work. This concludes our prepared remarks and we will now host questions. Evercore IC analyst Stephen Kim inquired, what level of construction starts do you feel you can achieve in the near term, and how will seasonality affect your starts cadence? Paul Romanofsky replied, we have seen a 30-day reduction in our cycle time, with consistent improvement across our divisions. Our starts and closings are in line with our expectations, and we are looking to increase our sales pace in the fourth quarter while staying in line with the market. Evercore IC analyst Stephen Kim inquired, could you explain why 25,000 is a significant figure and what your plans are for rental inventory investment in 2024 and beyond? David Auld replied, Steve, we are focused on increasing starts quarter to quarter. We believe that consolidating labor and material availability will help us program out our starts and build more efficiently. Our goal is to increase market share in each market, which will result in larger numbers of starts. Mike will answer the rental question. Mike Murray replied, hey, Stephen. We anticipate that the fourth quarter closings in the rental segment will have a lower profit margin due to a mix of projects with different costs. Paul Romanofsky replied, in terms of our forward investment, we currently have $3.3 billion in inventory. We've seen a significant increase over the last 2 years and anticipate that growth to continue, albeit at a slower rate. Deutsche Bank analyst Joe Allersmeyer inquired, can you provide more insight into the 9% year-to-date increase in community count? Are there any temporary factors that could cause this number to decrease in the back half of the year? Jessica Hansen replied, sure, Joe. We've been focused on increasing our community count. We have the capacity to open new communities and grow our community count, which has been low single-digit percentage in the last couple of years. We anticipate being closer to mid-single digits going forward. There may be some fluctuations due to when we close out of communities and bring them online. Our lot position is there and our operators are focused on growing their flag count. Deutsche Bank analyst Joe Allersmeyer inquired, what is the expected relationship between homes and inventory turnover and starts? Paul Romanofsky replied, we are focused on improving our inventory turn rate. Our construction cycle times have improved, which is helping us reach our goal. Historically, we have been able to turn our inventory 2 times in the following year. However, the last couple of years have been slower than that. We are aiming to get back to our more historic inventory turn rate for fiscal 24. David Auld replied, going back to the start, our focus is on increasing our capacity to deliver more homes in a faster and more efficient way. This helps us to reduce our inventory quarter to quarter and deliver more houses. UBS analyst John Lovallo inquired, what is the expected sequential cadence of orders from Q2 to Q4, and how does it compare to normal seasonality? Paul Romanofsky replied, I believe we are seeing a return to more normal seasonality in terms of demand. We are taking a consistent approach to ensure we have enough inventory to meet the demand, both in the existing and new home markets. We anticipate that this will lead to more consistent orders over the long term, though there is still a natural ebb and flow to consumer demand. David Auld replied, we anticipate that this quarter's sales will be higher than last year's due to our shortened cycle time and ability to provide customers with a date certain to close. This should result in a better than usual comparison to the same quarter last year. UBS analyst John Lovallo inquired, what factors have enabled DR Horton to increase home deliveries by 45 to 50% since 2019? David Auld replied, yes, we have been focused on simplifying our business and creating a consistent level of performance for many years. We have built a strong balance sheet and liquidity to take advantage of any market disruptions. Our platform is designed to provide affordability and consolidate markets through people, location, and product. We are seeing the power of this platform play out as we navigate the disruptions of the last few years. DIG analyst Carl Reichart inquired, Bill, could you break out the 4% decrease in stick and brick cost per foot year on year? What materials are driving that decrease, and is the single-family and multi-family rental platform helping to lower overall construction costs? Bill Wheat replied, right now, lumber is the primary component of our homes. We are seeing minor fluctuations in other materials. We are starting to see some improvement in labor costs, and we expect more as we add scale with our rental platform. This will help us drive our cost structure down relative to the rest of the industry. DIG analyst Carl Reichart inquired, has there been any change in the willingness or need of private builders to sell due to their disadvantage relative to publics? David Auld replied, Carl, we've had many conversations with private developers over the last couple of years. It's been difficult to make progress due to the rising cost of capital from private and bank sources. We have the opportunity to engage with these developers, but it's important to us that they fit our culture and values. We won't compromise on that. Jessica Hansen replied, we are thrilled to have acquired Truland, one of our largest lot developers in the Gulf Coast region. This acquisition has enabled us to expand our home building operations, while Nathan Cox and his team will remain a key partner in developing lots for us in the Gulf Coast. David Auld replied, I have had a long-standing relationship with Nathan Cox for over 15 years. He is an exemplary representation of our company culture and values. He has built a successful business, and we look forward to continuing our partnership for many years to come. J.P. Morgan Chase & Company analyst Mike Rehout inquired, what is your capacity to meet 4Q demand and take orders, and are there any production constraints that might hold you back? Jessica Hansen replied, sure, Mike. We're focused on long-term value creation and consistency quarter to quarter. Our starts pace is key, and we're positioned to increase it slightly from Q3. Our construction cycle times have improved and our flag count has grown, so we feel well positioned. We're more focused on positioning for 24 than worrying about Q4, but we expect to finish the year strong and add to book value. J.P. Morgan Chase & Company analyst Mike Rehout inquired, given the backlog and expected community count growth, what can we expect in terms of closings growth for next year? Bill Wheat replied, sure, Mike. We're looking to achieve double-digit growth in fiscal 24. To do this, we're positioning our lot positions in homes to ensure we can deliver on this goal. We focus more on inventory turnover than backlog, as backlog is just a factor of when we choose to sign a sales contract. We adjust when we release homes for sale based on when we have confidence that we can deliver them. Every home we start, we will close. Improving our cycle times will help us improve our inventory turnover, giving us better visibility into our closings. Jessica Hansen replied, we generally close 35 to 40% of our homes intra-quarter, so the backlog reported at quarter end does not reflect those sales. Home starts and inventory are better indicators of what we will close in the future. Barclays analyst Matthew Bouley inquired, what strategies are you using to manage lot costs and inflation going forward? Mike Murray replied, what we're seeing in the closings today is that lots contracted and acquired some time ago are coming through. We don't anticipate any cost pressure from these lots. Going forward, due to lot scarcity, we expect to see higher lot costs in our forward margins. We have factored in inflation of land, lot development costs, and finished lot prices into our guidance and planning for next year. Barclays analyst Matthew Bouley inquired, what is the maximum level of mortgage rate buydown you can do, and how does that change depending on prevailing mortgage rates? Paul Romanowski replied, the rate buydown has been an effective incentive for us. We've improved our cycle time and provided certainty of close date and home payment. We've stayed roughly a point below the market, and will adjust depending on rate movements. It's been one of our most successful incentives and will continue to explore it as interest rates change. Cleveland research company analyst Eric Bosshart inquired, what is the expected path of gross margins going forward? Bill Wheat replied, we have visibility into our backlog and recent sales, which have been accompanied by lower costs. We expect to see a sequential modest improvement in margin up to the high 23s to 24s range in Q4. We are seeing stabilization in our costs and demand, so we don't anticipate a trajectory of margin growth, but a sustainable level in the near to medium term. Mike Murray replied, tailwinds from limited inventory supply at affordable price points are helping our margins, while interest rates remain the biggest risk. If interest rates increase significantly, it could compress our margins. Cleveland research company analyst Eric Bosshart inquired, are consumers becoming less sensitive to buying down rates? Is this the medium-term reality we should expect? Paul Romanofsky replied, interest rates have been rising rapidly, so we've been using an incentive called a buydown to help buyers adjust. We have a variety of tools that we use to meet the needs of our buyers, such as closing costs, price, and included features. This has been a useful tool for us in this market, and we will continue to adjust to the changing conditions. Jessica Hansen replied, in Q3, we saw a lower percentage of buyers utilizing our incentive program compared to Q2. Seaport Research Partners analyst Ken Zener inquired, could you discuss the 53% of option lots you expect to be finished and what limits this from going higher? What factors determine whether you're taking down finished or raw land in those option structures? What is the cost of raw first developed lots to understand the inflation inherent in those? Jessica Hansen replied, I expect our lot purchases to exceed 53% this quarter. We're already closing 60% of our houses on lots purchased from third-party developers. We contract with land sellers, put an option on the contract, and then find a land developer. So, the 53% is more of a floor than a ceiling. Mike Murray replied, we are taking a piece of land, titling it, and then working with third-party developers to acquire the land parcels. We will either develop the neighborhood ourselves or purchase finished lots from third-party developers. This will result in an expected increase of 53% in our lot development. Bill Wheat replied, Ken, our capital and cash flow have seen a significant improvement this year, largely due to faster construction cycle times. We have less capital tied up in inventory per home, and our land shift over the years has also contributed to this. Seaport Research Partners analyst Ken Zener inquired, why is the housing starts pace per community now 4.6 compared to 3.6 in previous years? What has caused this shift in the industry? Paul Romanofsky replied, in regards to lot development, we have talented teams across our platform and it's important for us to have lots on the ground in order to maintain our starts pace. We make decisions on a community-by-community basis, taking into account timing, structure, and size. Our absorption per community may be impacted by larger communities, which can affect both construction and sales efficiency. Bill Wheat replied, Ken, it appears that the industry has seen an improvement in returns due to a shift in focus towards efficiency. Companies are becoming more efficient with their assets, resulting in improved absorption and turns in each community, leading to higher returns on capital. RBC Capital Markets analyst Mike Dahl inquired, what impact did the well-publicized deal between yourselves and a large SFR company have on 3Q and the guide for the year? Jessica Hansen replied, yes, we have closed homes and our leasing pace is strong. We have sold projects on an individual basis, but as we grow, we are seeing more interest from institutional investors who prefer to buy portfolios of projects. The deal you mentioned was speculation and we haven't commented on it. All of our rental communities are individual real estate transactions and we disclose the number of completed homes and rental units in our disclosures. We will continue to do sales of individual projects and packages of sales going forward. RBC Capital Markets analyst Mike Dahl inquired, given the total units you are now guiding to and the inventory you've outlined, should we expect a lower growth rate in 24 due to the inventory closing in 23? Jessica Hansen replied, our rental platform has seen strong growth in the past year, with 24 being a particularly big year for multifamily rentals. We anticipate continued growth in both multifamily and single-family rentals, though quarter-to-quarter and year-to-year results may be choppy. Our 10Q provides a breakdown of our unit numbers, which can be used to track our progress. Zelman & Associates analyst Alan Radner inquired, what are your thoughts on the sustainability of the progress you have made on cycle times and costs heading into 24? Are your trades ramping their headcount in anticipation of an accelerating start pace? Is there more capacity out there that would support this type of growth without cost inflation? David Auld replied, yes, we are committed to aggregating market share. We strive to make the process simpler and more efficient for our trades, so they can get to and from the job with the right materials and a full understanding of their tasks. This allows us to increase our market share. Our goal is to be the builder of choice for our trades, and we do this by making their job easier and more profitable without renegotiating prices. We believe this is sustainable and will continue to focus on it, improving our capacity over time. Zelman & Associates analyst Alan Radner inquired, could you provide us with an update on the share of closings that had mortgage rate buydowns and how that has impacted demand in the communities where you have dialed back those buydowns? Paul Romanofsky replied, the use of rate buydowns has decreased by about 10% in the last few quarters. Our sales agents are great at finding what's important to each buyer and helping them get comfortable with their purchasing power. This has allowed for some relief in the use of rate buydowns, and rates have remained in a similar range. Wolf Research analyst Truman Patterson inquired, what impact has the banking environment had on Horton's developer partners outside of Forestar, and are smaller private builders pulling back on spec construction and land deals? Mike Murray replied, we have a long-standing relationship with our third-party developers, and their banking and financing sources are comfortable with the land contracts we provide. We've been able to secure new financing commitments for them in the past quarter. The banking industry is being more selective in who and at what levels they support, but we've seen more opportunity to help private builders with liquidity and opportunities by taking some of their lots or stepping into different positions. This has been accretive to our business, and we're here to help. Wolf Research analyst Truman Patterson inquired, can you provide insight into consumer preferences for smaller or larger square footage homes over the past 6 months? Jessica Hansen replied, buyers are looking for the most square footage they can afford. We've seen a 2% decrease in the average square footage of homes closed year over year, but it was flat sequentially. We anticipate this trend to continue with gradual decreases in average square footage. Bank of America Merrill Lynch analyst Rafe Jadrosich inquired, what are current build cycle levels compared to historical levels, and what potential improvement in asset turns could we expect in the next year? Paul Romanowski replied, today, we are at 5.5 months in our current cycle time, which is slightly above our historical averages. We are seeing a trend towards more normalized and consistent cycle times, however this will depend on labor availability and our ability to aggregate that labor. As start space increases across the country, there could be some pressure on that, but we feel confident in our position and trade capacity. Mike Murray replied, our build time has decreased by a month, and we anticipate another month or so to reach our historical efficiency. After that, it will take 45 to 60 days for construction completion, resulting in an average start to closing cycle time of 6 months or less. Bank of America Merrill Lynch analyst Rafe Jadrosich inquired, what is the outlook for rental profits in the fourth quarter, and what is driving the margin cadence? Bill Wheat replied, yes, as Mike mentioned earlier, we are seeing a short-term impact on our gross margins due to the mix of projects and higher construction costs. We anticipate that our rental margins will remain higher than our home building margins in the long term, though there may be some anomalies in Q4. David Auld replied, thank you, Paul. We appreciate everyone's time on the call today and congratulate the D.R. Horton family on a successful third quarter. We look forward to sharing our fourth quarter results in November. Thank you.